Good afternoon, everyone, and welcome to the Deep Dive. We're here to give you that essential shortcut, really digging into what's actually moving the markets today, September 2nd, 2025. And today, it's a really fascinating picture we're looking at. It feels, well, contradictory.
It really does.
On the one hand, you've got this sort of broad caution, right? Almost a palpable anxiety about the macroeconomy. You feel it globally.
Absolutely. A real sense of unease.
But then you zoom in, you look at specific companies, and you're seeing these huge explosions, these opportunities just popping up based on very specific news.
It's a tale of two markets completely, a real split picture. And that makes it perfect for a deep dive, I think.
Exactly. It's this dual reality we're seeing. The market's holding its breath on the big picture stuff. You know, central banks, economic data.
Parsing every word.
While also reacting, sometimes wildly, to individual company stories. It's not simple. It's this constant push and pull.
And understanding that dynamic, that interplay, that's where the real insight is for you today. It challenges those easy narratives.
Yeah, and that's our mission here. We spent the morning sifting through, all the pre-market reports, the analyst notes, forecasts, even geopolitical updates. We do the heavy lifting for you.
Giving you that shortcut.
Exactly. We want you to get what's really setting the tone, what's just background noise, and what's actually creating those big moves. So you're properly informed without drowning in data. And the immediate tone, well, as we start the trading day, it definitely feels defensive. Major indices, U.S., global, they're pointing lower.
Yeah, it's a pretty clear signal, a broad risk-off sentiment taking hold.
Risk off. Yeah.
Risk-off is definitely the phrase of the morning, but for you navigating this, it's more than a phrase, right? It's a real shift in where money is going.
Meaning people are pulling back from riskier things like stocks.
Generally, yes. Moving towards things perceived as safer, maybe government bonds, certain commodities. It's all driven by this heightened uncertainty. But the key is not just that it's happening, but why it's so dominant right now and how it's showing up differently across asset classes. That's where we start connecting the dots for you.
All right, let's unpack that, this risk-off feeling.
Yeah.
The main driver seems to be this intense focus, almost microscopic, on the health of the U.S. economy.
Right. Everyone's just waiting, holding their breath for confirmation, or maybe hopefully a contradiction of those recession fears that have been hanging around.
Feels like we've been talking about recession fears for months.
We have. And today there's one specific piece of data that's really the flashpoint. The big one everyone's watching.
Which is?
That's the ISM Manufacturing PMI report. It's due out 10:00 a.m. Eastern.
Okay, the PMI. Why is that so crucial right now?
Well, for anyone tracking industrial health, it's not just another number. It's a key leading indicator. It's a survey of purchasing managers, of people actually on the front lines, placing orders, managing inventory.
So it gives a real-time pulse.
Exactly. It offers a real-time pulse check. And today, its role is pivotal because it could either, confirm those growing recession fears if it comes in weak, or if it's surprisingly strong, it could signal some unexpected resilience in the economy. Maybe things aren't as bad as feared.
So it's not just the headline number we should look at. You mentioned digging into the details.
That's crucial because the headline can hide a lot. We're looking at the subcomponents like new orders that tells you about future demand. Employment gives you a read on hiring in manufacturing.
Inventories, too.
Inventories, right. Are companies building up stock or drawing it down? That impacts future production. So if these parts, especially new orders, come in weak, below that 50 mark indicating contraction,
then the recession narrative gets stronger.
it really solidifies it, yeah. You could see markets sell off further as people brace for slower earnings. It basically confirms the bearish view, for now at least.
So a bad report could really speed up this flight to safety we're seeing. Could it even influence the Fed?
Potentially. It adds pressure, certainly. Though they're also watching inflation, as we'll get to. But what if it surprises on the upside?
Right. What if it's resilient?
Well, if new orders rebound or employment stays strong, that could ease some anxiety. Suggest the manufacturing sector's holding up better than we thought?
Could spark a relief rally?
Could definitely spark a relief rally in stocks. People might rethink those recession odds. But, even a good report raises questions. Is it sustainable? Is it just one sector doing well?
So either way, that 10 a.m. number is huge. A potential market mover.
Absolutely. Everyone's watching that. It could really set the trajectory for the next few days, maybe longer.
And adding to this general nervousness, another indicator is flashing red, right?
The
VIX.
The VIX, often called the fear gauge. It measures the market's expectation of volatility over the next 30 days based on S&P 500 option prices.
And it's up significantly.
It spiked quite a bit in pre-market, over 17%, sitting around 17.0 last I checked.
Wow, 17% is a big jump pre-market. What does that really tell you about trader behavior right now? What's the shift?
It tells you traders aren't just worried passively, they're actively repositioning. They're expecting turbulence and they're hedging.
Hedging meaning buying protection.
Exactly. Buying protection against potential drops. Things like put options, maybe inverse ETFs. The cost of that protection goes up, reflected in the VIX jump.
So it's not just worry, it's money moving. Active capital redeployment.
Precisely. And when so much capital shifts to defense, it can actually starve the rest of the market, dampening any potential upside, even if news isn't terrible.
It becomes a bit self-fulfilling. The fear creates choppiness.
It can, yeah. It's a powerful signal. It tells you managers are literally paying for insurance. They're not just thinking about risk, they're acting on it.
Okay, so we have economic worries, we have active hedging, and then, just to make things more complicated, there's geopolitics.
Always a factor lurking in the background, but today it's actively stirring things up again.
What specifically?
Renewed escalations in the Russia-Ukraine conflict. We're seeing reports, confirmed reports, of fresh attacks targeting Russian energy infrastructure.
Ah, and that immediately makes you think energy prices.
Directly. It's not just a headline. It has immediate market consequences. We're seeing WTI crude futures, that's the U.S. benchmark oil price, up almost 2%, trading around, what, $65.21 a barrel?
So oil's up almost 2% because of supply disruption fears.
Exactly. Concerns about potential supply issues, the risk premium in energy goes up, and that ripples out.
Which means inflationary headwinds, right?
Yeah.
For you and me, that often means higher prices at the pump, higher transport costs. It feeds into inflation.
Precisely. And this is where it gets really tricky, especially for central banks.
How so?
Well, rising oil prices feed directly into headline inflation. But central banks, like the Fed, they're trying to tame inflation, right? Often by raising rates, tightening policy.
They're also trying not to kill economic growth.
Exactly. It's this delicate balancing act. Higher oil makes it much harder to bring inflation down without hitting the brakes too hard on growth, which is already looking shaky, as we discussed with the PMI.
It's a classic dilemma. Damned if you do, damned if you don't.
It really is. A treacherous tightrope walk. Raise rates too much to fight oil-driven inflation. You risk a deeper recession. Don't raise them enough. Inflation stays high. They're caught between that rock and a hard place.
So, okay, the big picture is definitely cautious. Economic data watch, VIX spike, geopolitical tensions pushing oil, and inflation worries.
That sums up the macro headwinds pretty well. But, as we said right at the start, this isn't the whole story. There's that fascinating split market happening at the same time.
Right, let's pivot to that, because amidst all this caution, you see these pockets of, well, almost mania sometimes, especially around AI. Although the narrative there, it's changing, isn't it?
Oh, definitely changing.
It used to be, just mention AI and your stock flies, not so much anymore.
Much more discerning now. Yeah. The market's matured past that initial sort of hype phase. Investors aren't just buying the buzzword.
They want proof.
They want tangible evidence, real execution, measurable growth from actual AI products, and, critically, a path to making money from it. It's moved from potential to performance.
And NVIDIA is maybe the perfect example of this scrutiny right now. They reported fantastic numbers, right? Huge profit, record revenue.
Phenomenal headline numbers, $26.4 billion profit, record revenue. A year ago, that stock would have just skyrocketed, no questions asked.
But it's actually under pressure in pre-market. Why? What's the market focusing on?
This is where it gets really interesting. It's not the overall numbers. The market is laser-focused on a slight slowdown, and I mean slight in the growth rate of their data center business.
Their fastest growing segment, the AI powerhouse segment.
Exactly. For a company valued so highly because of that explosive AI growth, even a tiny deceleration in that key segment, especially if it misses very high expectations, makes investors nervous.
They're looking past the massive current success to the trajectory.
Precisely. They're scrutinizing the future growth path. Are competitors catching up? Is the growth rate simply cooling from unsustainable levels? Any hint of that, and the stock gets punished, despite the record results.
So it's not just about being big and profitable anymore. It's about growing fast enough, especially in AI. The nuance matters hugely now.
Hugely. The market wants tangible, high-growth application. Real evidence AI is driving accelerating, sustainable, profitable revenue. Not just, aspiration talk. It's maturing.
Okay, so that's NVIDIA facing pressure despite
Yeah.
records. But then you look at Alibaba, completely different story today.
A stark contrast, yeah. Alibaba surged, what, 19% in Hong Kong trading?
Incredible jump. Why are they getting rewarded so much when the overall mood is cautious and even NVIDIA is getting scrutinized?
It's a perfect example of the market rewarding what it sees as real, tangible execution. Alibaba reported triple-digit growth in their AI-related products. That's a big number.
Okay, so strong AI product growth.
Yes, showing real traction there. But also, they reported a really strong 26% jump in cloud computing sales.
And cloud is the foundation for a lot of AI stuff, right?
Exactly. Cloud is the essential infrastructure. So putting those two together, strong AI product growth and strong growth in the underlying cloud infrastructure, that tells a very compelling story.
It shows they're not just talking AI, they're building the foundation and selling the products effectively.
Right. They're delivering both ends, the infrastructure and the applications, and turning it into significant, measurable revenue in critical areas. It's a cohesive strategy executed well. That's what the market is rewarding big time, as you said.
So the takeaway is clear. Actual results, real execution, tangible growth in these key sectors gets the reward, even in a tough market.
That's the bottom line. The market's making a sharp distinction now, and this isn't just about the giants like NVIDIA and Alibaba.
Right.
We're definitely seeing what you'd call a stock picker's market emerge, especially maybe in smaller cap companies.
Where specific news can just completely override the macro mood.
Absolutely. These smaller stocks can have those incredibly outsized moves, totally bucking the trend, often on very specific news. Lower liquidity, less analyst coverage means news hits harder.
Like Professional Diversity Network, IPDN. I saw that was up to, what, 246% pre-market?
Astronomical.
Truly eye-popping.
And the catalyst, a non-binding agreement. Just a memorandum of understanding, mind you, to develop a Web3 digital investment banking platform.
Web3, blockchain, decentralized finance.
Yeah.
Hitting all the hot buzzwords.
Exactly. Tapping into those themes, blockchain, DeFi, the whole Web3 ecosystem. These are areas that capture investor imagination, looking for that next explosive growth area, even if it's still speculative.
So even just an agreement, not a finished product, can cause that kind of move in a small cap.
In this environment, yes, especially in a smaller name. It shows the power of these narratives, these hot themes, even when they're still largely conceptual. Retail interest, maybe short squeezes, play a role too.
And then there's Moano, MOV, up over 80%, another huge jump. What was their story?
Moano's news was maybe less flashy, but arguably more fundamental for them. They received a NASDAQ listing extension.
Okay, sounds procedural. Why is that worth an 80% pop?
Well, for a smaller company, staying listed on a major exchange like NASDAQ is absolutely critical. It's about credibility, liquidity for the stock, access to institutional investors who might have rules about only buying listed stocks.
So avoiding delisting is a big deal.
A huge deal. Getting that extension is basically a vote of confidence from NASDAQ. It signals they have a path to meet the requirements. It removes this massive cloud of uncertainty that hangs over a lot of small cap.
So it dramatically reduces a key risk for them.
Exactly. And it just shows how super specific, company-centric news, even kind of administrative news, can totally dominate the narrative for that particular stock, regardless of the broader macro fear.
Okay, but with all this talk of Web3 hype and listing extensions driving huge gains, profitability still has to matter somewhere, right? We're not totally ignoring earnings.
Excellent point.
Yeah.
And absolutely critical. Profitability does matter, maybe more now than it did a couple of years ago with higher interest rates, higher cost of capital.
It's not just growth at any cost anymore.
Definitely not. And CNVS is the cautionary tale today. It's down sharply, over 18% pre-market.
Ouch, what happened there?
They reported Q1 earnings, and here's the key. Their revenue actually beat analyst estimates. So top line looked okay. But their earnings per share, the EPS, the actual profit per share, that missed analyst estimates.
So they sold more stuff than expected, but made less profit on it than expected.
Precisely. And that's sending a very clear signal from the market right now. In many cases, the bottom line is being prioritized over just top-line growth, especially if that growth isn't translating into earnings efficiently.
Investors want to see the real numbers, the actual profit.
They want to see the real numbers, a clear path to sustainable profitability. This focus isn't just in stocks like CNVS. You see echoes of it across different asset classes, too. It's a broader shift.
Okay, so let's talk about those other asset classes. With this risk-off mood and focus on real numbers, are we seeing the classic Flight to safety.
We definitely are seeing some classic flight to safety behavior. It's a textbook response when uncertainty ramps up like this.
And the classic safe haven is gold, right? Seeing movement there.
Absolutely. Gold is up over 1% today. That's a decent move for gold in one session.
Why gold traditionally?
It's seen as a store of value, a tangible asset outside the traditional financial system in a way. Its value isn't tied directly to one company's earnings or one government's policy. So when stocks feel shaky or people worry about inflation or currency devaluation,
They turn to gold.
they often turn to gold. That 1% jump is a clear sign investors are allocating capital there, hedging against market drops, and maybe those inflation fears from rising oil too.
And the U.S. dollar. Often strengthens in times of trouble too, right?
Yes, the dollar is strengthening notably today, especially against other major currencies like the euro, the pound.
Why does that happen, even if the U.S. economy itself is under scrutiny?
It's another key part of that flight to safety, but on a global scale. When global investors get nervous, they look for stability and liquidity. And the U.S. dollar, backed by the massive U.S. Treasury market, is seen as the ultimate safe harbor.
The world's reserve currency status matters here.
Hugely. Its role in global trade, the depth of the Treasury market. It makes the dollar the go-to place to park capital during global stress. It's about seeking stability, even if the U.S. has its own issues.
Okay, so gold up, dollar up. Classic safety, plays acting as expected. But you mentioned treasuries earlier. The bond market, things are a bit weird there.
That's where it gets really interesting. Yeah, the bond market is acting. Well, it's showing the tension. It's fascinating.
How so? Usually in risk-off, people buy bonds for safety, right? Prices go up, yields go down.
That's the typical playbook.
Yeah.
But today, we're seeing 10-year Treasury note futures actually declining. Prices are falling.
Prices falling means yields are rising.
Exactly. Yields are rising, which is counterintuitive in a flight to safety moment.
So wait, people are selling bonds. Why would they sell bonds if they're scared about stocks and the economy? Shouldn't they be buying them?
Okay, this is the tug of war. It perfectly shows the conflicting fears playing out.
Okay, lay it out for us.
On one side, yes, you do have some investors buying bonds for safety, moving out of stocks. That's the traditional move.
Right.
But, and this is the key, you have other investors, significant ones, who are selling bonds.
Why are they selling?
Because they fear inflation. Remember, the oil price is going up because of the geopolitical stuff?
Yeah, the inflationary headwinds.
Right. So rising inflation is bad for bonds, especially longer-term bonds. If inflation eats away at the value of your future fixed payments, the bond becomes less attractive.
So they sell because they think inflation will erode their returns.
Exactly. They fear the purchasing power of those bond payments will decline. So they sell, pushing prices down and yields up. They might be looking for other inflation hedges or just waiting for higher yields before buying back in. Okay. So it's a battle. Stock market fear pushing some into bonds for safety. While inflation fear is pushing others out of bonds because they think rising prices will hurt bond returns.
You nailed it. It's a direct clash between stock market fear and inflation fear playing out right there in the Treasury market, especially the longer-term bonds like the 10-year.
Wow, that's a really complex dynamic.
It is. And watching how that resolved today, do bond prices stabilize and rally, suggesting stock fear wins out? Or do they keep falling, meaning inflation fear is dominant? That will be a crucial tell for you about which anxiety is really driving things right now. It's a key indicator to watch.
Okay, so pulling this all together for you, the listener, navigating this complex day, what's the absolute bottom line, the key inflection point we need to watch?
It really comes back to that ISM manufacturing PMI report at 10:00 a.m. Eastern. That's the data point with the most potential to shift the narrative today.
Cannot stress that enough. A weak number could really confirm the downturn fears, push things more risk-off. Right. Accelerate the move away from stocks, maybe increase talk of Fed cuts down the line, although inflation complicates that.
But a surprisingly strong number.
Could spark a significant reversal, a relief rally. Ease some of that macro anxiety, at least temporarily. It's a real make-or-break moment for the day's trajectory.
Okay, so summing up for you.
Oh.
The market's definitely starting September defensively. You've got these broad economic worries driving caution, that ISM report looming, the VIX spike showing active hedging, the geopolitical tensions boosting oil and complicating things for central banks.
That's the cautious macro backdrop, absolutely.
But at the same time, don't ignore the micro. You have these pockets of hyper-speculative moves, these strong surges in individual stocks based purely on company news and execution.
Right. Alibaba showing execution gets rewarded. Smaller caps like IPDN and MOVE showing specific news, whether it's a Web3 MOU or a NASDAQ extension, can create explosive moves completely detached from the macro mood.
It really highlights that it's a stock picker's market in some ways. You can't just ride the index.
Definitely. And profitability matters, as CMVS showed us. The market wants those real numbers on the bottom line.
So it's challenging setup. Caution on one side, these specific, almost frantic opportunities on the other.
It is challenging, intriguing though, because it demands you pay attention to both the big picture and the specific company stories.
Very much so. Requires seeing the forest and the individual trees.
Exactly.
All right, maybe one last thought for you to chew on today as you watch things unfold. Think about how this prevailing mood, this risk-off feeling we've dissected, might be subtly coloring how you see everything else.
That's a really great point. A crucial question for anyone trying to think clearly in markets. How does the dominant story, the fear, the caution, affect how you process new information?
Right. Does it make you amplify negative signals and maybe unconsciously ignore positive ones?
Yeah, how does that background noise influence your look at potential investments or even just how you read the headlines?
Exactly. When collective fear is high, like with the VIX spike today, are we maybe overlooking genuinely good companies? Companies executing well with solid fundamentals just because they don't fit the gloomy narrative?
Are we discounting real value because the overall mood says be careful, or because money is just flowing out of growth indiscriminately?
It's about market psychology, isn't it? And our own susceptibility to it.
Absolutely. Something to really consider, not just today, but always. How does the overall sentiment affect your own lens? Are you filtering effectively or just getting swept along?
Being aware of potential bias is key.
It's critical for making informed assessments and maybe spotting those opportunities others might be missing precisely because they're caught up in the prevailing mood. An excellent thought to keep in mind.